The information, opinions, and recommendations presented in this podcast are for general information only, and any reliance on the information provided in this podcast is done at your own risk. This podcast should not be considered professional advice. Please consult your tax advisor, even if it's us, to find out how this may apply to your specific situation.
Hey listeners, and welcome to Tax Trails. Today, we'll be doing a follow-up episode on the One Big Beautiful Bill that has now been finalized and the provisions specific to businesses. Here are your hosts, Derek and Spencer.
Thanks, Chandler.
Thank you. Woo. So we just did the individual side. Hopefully this gets posted somewhat close to the...
Yeah, you better be listening to this right after
Yeah.
the individual.
I mean, who doesn't want to listen to a podcast about the OB?
The OB.
That sound...
We've been messing with Spencer about what he's going to call, because you called TCJ TICJA.
TICJA, OB,
OB squared.
OB cubed,
Oh yeah, OB cubed, not OB squared. That was
The- OBBB.
Should we start this episode over so I can cut that out?
No, you're fine. Yes, so today we're going to be talking about what specific changes are for businesses. And first we're just going to talk about, I think one of the biggest things that impacts, I would say 99% of all businesses, and it was bonus depreciation. So we talked about this a little bit in some of our prior podcast episodes about bonus. For those who don't know, bonus depreciation was introduced with the Tax Cuts and Jobs Act, and it was 100% for a couple of years, and then slowly has been phasing out. And I believe for 2025 it's down to 40%, if I remember right, or
For 2025 returns that were going to be filed next year, it would have been 40%.
Yeah. So with this bill, they have now brought back bonus depreciation, and it's increased to 100% for qualified property acquired and placed in service after January 19th, 2025. And qualified property just means depreciable property under makers, which is just modified. It's just the tax depreciation, essentially, and has a recovery period of 20 years or less, which is a lot of assets. Think of cars, think of furniture, computer equipment.
Most things that aren't like real property, so buildings and things like that, like lots of, pretty much all the stuff, all the stuff
That goes into a building.
that goes into a building, yeah. But yeah, anything other than a building, and with some some exceptions, but really a lot of equipment, it falls under that 20 years.
So that's what qualified property is. So those could be just 100% depreciated. So instead of taking a deduction for its useful life, so if you bought an asset for 5 years, or you bought an asset and its useful life is 5 years, normally if you didn't bonus it, you would have to take the cost of the asset and stretch it
over
out
5 years.
Yeah, stretch it out over 5 years. Bonusing, you can just expense it in the year that you essentially place it in service and you buy it.
That brings back tax planning options for buying equipment. You can potentially get a larger tax deduction with a smaller cash outlay if you're financing equipment and things like that in your business. Again, don't let the tax tail wag the business of the dog business. Don't
Yeah.
don't just
That was really insightful.
yeah. Don't make your decisions based on tax only. Use good financial sense, but
Right.
there you go.
But if you were going to buy some equipment anyway,
it brings back that option.
right?
So
Yeah, even if you buy it and place it in service December 30th,
exactly.
still 100%, right, for the year. So, however, as a reminder, any items purchased and placed in service before January 20th are still, January 20th, 2025, are still subject to old phase-out rules.
I
Yes.
still think that date is, I'm really glad this 100% is back. I'm not looking forward to next year double checking to see if anything was placed in service before the 19th of January.
It'll be another. So when did you actually put this into service? Was it before January 20th or after?
Yeah. Annoying.
But that's okay, because if you can't bonus, then we have Section 179.
Yep. So 179 Everyone's favorite code section. So in lieu of bonus, you can elect to take a 179 expense on your assets, and that in theory could allow you to expense 100% of your assets in the year that you purchase them. But there are some limitations, and what the OB is going to change is they're going to increase those limitations, essentially making Section 179 more available, more applicable in more situations. So the dollar limitation is increased up from 1.25 million up to 2.5 million, and the total investment limitation is increased to 4 million, and these amounts are going to be adjusted for inflation. That being said, I don't know, 8 times out of 10, you're probably just going to elect to take bonus depreciation, but there are plenty of situations where maybe 179 will be the move, especially when you take into account some state tax considerations.
Yeah, some states might not. They might decouple from federal on the bonus side of things, but not on 179.
Yep.
So
And vice versa, though.
yeah, and vice versa. Some states don't like 179, so you just kind of have to be aware of that.
Yep.
But yeah, so we have 179.
Oh yeah.
Changes.
Sorry, and then so then next change, energy efficient commercial building deduction. So this has been around for a while, and the bill is going to terminate this deduction essentially. So for property.
This audio was created with podcastle.ai.
Essentially, so for property beginning construction after June 30th, 2026, you're not going to be able to take the energy efficient commercial building deduction any longer.
Yeah. So prior to this, you could, like these building developers or whatever would be able to claim a deduction for the cost of certain like energy saving improvements to buildings. Yep. The deduction would obviously decrease the basis of the building, but that was to like free up deductions so that you wouldn't have to like capitalize it and then expense it out over the life of the building. So
right.
But now, after June 30th, 2026, it's
yep.
gone.
As with so many other things, this bill it was the anti-green initiative.
Yeah, whatever the opposite color of green is.
Yeah,
it's the opposite of that.
Yeah, well, who's the Green Lantern's enemy?
It's the yellow. Isn't it yellow?
Yeah,
It's the color yellow.
yeah, that's right.
This is the yellow.
The yellow initiative.
Yeah, the yellow initiative.
Yeah. So and that was for commercial construction anyway. But yep, that is gone now. Mm-hmm. So now, Spencer, you got to talk about one of your little babies. You've given us internal trainings on this topic.
Yeah,
and so it's kind of been interesting and fun. I know you've got good information on this next piece.
Yeah, so Section 174. I like 174, like research and experimentation is what that is. Or there's the R&D credit, which has to do with Section 41 expenses, which is a subset of Section 174. You probably don't need to know that, but
Related.
yeah, they're related. So in the past, and this was a big part of the Tax Cuts and Jobs Act, where all your research and experimentation expenditures could be deducted. Well, you could decide actually if you wanted it to be deducted in the year that you incurred it and expensed it, or you could amortize it over 5 years. But most people just expense it in the year that they incurred it. It's easier to track that way.
Right.
And it's just better overall with cash management, cash flow. However, with the Tax Cuts and Jobs Act, they made it change in 2022 was the first year.
Yeah, so I mean the law was passed in 2017, and then this change didn't go into effect until 2022, right? And so like when the law was passed, everybody knew that this thing was coming out there, and they thought it would maybe change before we got there, and then we hit to 2022, and what happened?
Yeah, and then everyone's like scrambling around trying to figure out like is this going to be a legit thing? Like, so many people extended their returns because they didn't know if Congress was going to band together to make it, bring it back to fully expensing it in the year. Nothing happened though.
Yep.
Some bills made it pass, like either the House or the Senate, but it never went to the other side and got passed. So it was for 3 years, almost pretty much. We've been having to capitalize and amortize domestic and foreign 174 expenses, research and experimentation expenses.
Yep.
So now with this, though, with the One Big Beautiful Bill, it has now brought back that taxpayers can immediately deduct domestic, not foreign, but domestic research and experimentation expenditures paid or incurred in the tax years after December 31st, 2024. Foreign must continue to be capitalized and amortized over 15 years, so that doesn't change. And as a reminder, a foreign 174 expense is if the work is being done outside of the U.S., it's foreign. Doesn't matter if you're paying like a U.S. company to do it. If their contractors or their workers live in outside of the U.S., then that would be 174 foreign expense. There is some relief and some accelerated provisions. So there's a small business taxpayer relief. So small businesses with average annual gross receipts of $31 million or less may retroactively elect to apply this change to tax years beginning in 2022. So what you can do is you can amend your 2022, 2023, and 2024 tax returns to fully expense your domestic research and experimentation expenses.
That's potentially a big deal.
Yeah. It would be a lot of work, but you would be able to retroactively get a lot of.
Yeah.
These could be huge deductions for people. The ones that do capitalize it can be millions of dollars. Right?
Oh yeah, 100%.
And we were still we hadn't hit the 5-year break even point yet,
Yeah.
right?
Yeah.
In theory, if you're always having a similar amount of 174 expenses each year, by year 5, you're essentially deducting the same
amortization
amount.
costs
The amortization is the same as what your current year expense would be. So you'd kind of be on schedule, but we hadn't hit that yet. So we were still in that, paying more tax than we had to, I guess.
Yeah. And they're saying that if you want to do that, you have to do this before July 4th, 2026, and it requires to amend your returns for those tax years.
Okay.
So there's the small business taxpayer relief. There's another thing. It's the accelerated provision, where if you have domestic research and experimentation expenses after December 31st, 2021, and before January 1st, 2025, you can elect to accelerate the remaining deductions for those expenses over a 1 or a 2 year period. So in your 2025 tax return, you can accelerate all of those leftover research and experimentation expenses in 2025. And if you want to do it over 2 years, you can do it for 2025 and 2026. So essentially, you should be, by the end of tax year 2026, you should be pretty much all caught up.
I think it's interesting that they give you both options, and I guess it's nice that they give you both options because, right, depending on your situation, it might be more beneficial to go back and amend, or it might be more beneficial to go ahead and accelerate them all now.
Right.
But
what if in 23, I don't know, you go back and amend it and you had a huge tax bill that year, but if you accelerate it all in 25, it might not help you because you're already in a loss.
Exactly.
So.
Yeah, you want to look into some tax planning of what does 2025 look like.
This audio was created with podcastle.ai.
Yeah, you want to look into some tax planning of what does 2025 look like, maybe even what does 2026 look like, because you could do it over 2 years, right?
Right.
And would you rather, refund, catch those deductions in the prior years? I mean, it's still going to affect you in this year. If you amend in this year, you're going to get the cash this year. You won't have to necessarily wait till you file your 2025 return if you amend.
Right.
But you can also just wait, if you don't, because, amending a return is going to cost whatever tax preparer you use, it's going to cost money.
Right.
So do you want to spend the money to amend 3 years, or do you want to just tack it onto your 2025 tax return and not have to do that? So there's
Interesting. It's well thought out, in my opinion, giving you both options. That's
Right. There was consideration given to like how this might affect
yep.
prior and current years. And
Yeah. So it's just something. It's definitely a big change for sure, and I like the fact that domestic is 100%. You deduct it in the year, and obviously they're keeping foreign. You have to capitalize foreign, and that's just to incentivize you to pay for.
Yeah, it's incentivizing domestic investment.
Mm-hmm.
did they change the amortization period for foreign, or is it still 15?
It's still 15 years. Yeah. So.
Yeah, that's interesting. Think about what you're going to do.
Right.
It might be cheaper to hire somebody in another country, but if you can't deduct it right now, then I don't know. Maybe think about it. Interesting. I like it. All right, moving on. Qualified business income deduction. So the original version of the One Big Beautiful Bill that came out of the House proposed changing the total deduction to 23% of qualified business income. However, the final version of the bill kept it at 20%.
Yeah.
So,
and without this bill, we wouldn't even have it. It would.
well, so yeah, yeah,
Would've
that's right.
expired, right.
So made it permanent.
Mm-hmm.
And so that's nice. Yeah, that was set to expire and sunset with TCJA. So now that's a full-time permanent deduction you get for your qualified business income. Expands on the W-2 and capital investment and SSTB limits, specified service, trade or business limitations, allowing for larger limits, meaning it's more available to
More people.
essentially. And then it introduces an inflation-adjusted minimum deduction of $400 for taxpayers with at least $1,000 of qualified business income. And that's, I don't know, that's a nice little bone. Like,
Yeah.
like,
If you make too much, if you're over the limits or what, your qualified business income could be really, really small.
right.
With a lot, even if you have like a lot of qualified business income.
Yes.
So allowing this is kind of like, here you go. Like,
But it's also it also benefits on the small end, right? If you have a really, really small qualified business income, if you have if you have at least $1,000, you're getting that $400 deduction, and then inflation adjusted.
Mm-hmm.
Again, that's one of the things I like in this bill in general. Is so many of these items are now being adjusted for inflation. I know we touched on our last podcast. I love that. It's still weird the things that don't get inflation adjusted.
The best one is the gift one.
Right.
That's my $25.
$25
per unique
and it's
recipient.
been that way forever. And
Like you can blow through that so easily.
it's hard to get a gift for $25. So, yeah, this is nice, and
yeah, it's good to have QBI.
yep,
I like QBI. It's kind of complicated, but it works out really well for individuals.
we've gone more in depth on QBI in other podcasts.
Mm-hmm.
So,
If you're interested, go give them a listen.
yeah, go listen through the catalog.
Plug. Okay, next we're just going to talk about a couple of credits that are going away. So again, this is the yellow deal, the commercial clean vehicle credit for businesses that buy clean vehicles. That this terminates for vehicles purchased after October 1st, 2025. The new energy efficient home credit terminates for homes acquired after July 1st, 2026. In the past, eligible contractors could claim a credit for selling or leasing new energy efficient homes that they build located in the U.S. Now it's being terminated. So You have until July 1st of 2026, I guess, for those credits.
Yep. Yep. Just, yeah, getting rid of those green initiatives. So, I don't know. It's weird, but it is what it is. So this is an interesting credit, an employment related credit. Um, FICA tips credit for beauty service businesses. So, tip income is treated as employer provided wages, which means it's subject to FICA taxes. And businesses can now get a non refundable credit for the portion of FICA paid by the company for employee cash tips. So, that has previously been available for food service businesses. And now this makes it available for beauty service businesses. And so I think that is a nice little carve out because that's another really tip heavy industry,
Yeah.
right?
Yeah. And I think this is kind of going along like with the no tax on tips thing, and they're like trying to help out those service industries that heavily rely on tips.
Yep. One interesting thing is
This audio was created with podcastle.ai.
Rely on tips.
Yep. One interesting thing is, I think the whole deal with the no tax on tips and these credits and deductions is, I think a lot of it is also to get people reporting their tip income,
I think so too.
which is an interesting thing that maybe some people aren't thinking about, but it's really easy to hide cash tip income. And
Yeah, especially if you just leave a cash, like straight cash on
that's
the table.
what I'm saying. Yeah, cash, real physical money,
Yeah.
right? Being left on the table, that's really easy to hide.
Well, and this is like an incentive for companies to like start reporting it on people's W-2s
Exactly.
so they can get this refund.
So while on the surface this may look like a tax cut, I wonder what the net effect of it is.
Yeah, I wonder if they're actually going to get more in payroll tax
Exactly.
than what they're going to be giving in.
Maybe that was the intention. Yeah, I don't know.
It's like a little sneaky, smart play.
I mean, when I was serving, like no one was reporting their cash tips
Except for you.
except for me. I'm always honest.
Of course.
No, but I mean,
We're
it was-
ethical.
Yeah.
and it was seriously one of the it's just one of those like things that people are just think is normal about the industry is just kind of like
Yeah. And that's weird.
just not reporting it at all.
Yeah.
Or like reporting just a small amount because they have to. I mean, if you have us under a certain amount, then the company has to pay you
Right. So you just would
Minimum
report
wage,
the
so-
bare minimum required, basically.
basically enough so that no one comes and asks you.
Yeah, that's weird.
Yeah.
So this will increase that reporting, is my guess. So,
Yeah, and it's not really being talked about a lot, I feel like,
Yeah.
these sort of things.
So that's the kind of insight you get on this podcast, you know.
Well, this is like, yeah, for sure.
But some people might be like, I'm not reporting them, and they're still taxable over 25,000 or something, and I'm just going to keep on not reporting them. Like
Yeah.
there's probably a good amount of people that are going to do that.
Yeah, and in Utah, there's a lot of beauty service businesses.
There are. Yeah, we've got a lot of that, plus a lot of stay-at-home moms who are able to do that out of their home or things like that too. And so,
Yeah.
yeah.
So going with employment-related credits, they changed employer-provided child care credit. So businesses, this one big beautiful bill, businesses could get a credit equal to 25% of qualified child care expenditures up to a maximum of $150,000. Effective after December 31st, 2025, the credit is increased to 40% and increased the maximum to $500,000. But for eligible small businesses, the credit is 50% of the qualified child care expenses up to a max of $600,000. And what is a small business? It just has to meet the gross receipts test over 5 years instead of 3. So
Oh, that's interesting.
the gross receipts test is an average of 31 million or less.
And that gets adjusted for inflation each year too. So
Yeah, it does.
Yeah.
And then the maximum amounts will be adjusted for inflation. That's like 500, 600. one thing to note that they mentioned in this new provision of the employer-provided childcare credit, small businesses can pool their resources to provide childcare for employees, and businesses can use a third party to facilitate this childcare services for the employees. So it's kind of helping small businesses come together and pool their expenses.
What does that mean, Spencer?
So essentially, like a business, like, so if all three of us have like a dog grooming business,
Yeah.
and we have employees, and let's say we want to provide childcare for our employees, but it's too expensive for just like me to provide it, or like
Okay.
I don't have enough employees to warrant like paying for that. We can pool our resources, us three, and provide it to our employees.
Oh, got
And, like,
it.
You pay a portion, I pay a
So
portion.
if we like all lived in or had our offices in the same business park or something,
Yeah.
and then we
That collective business park could provide one child.
maybe
area.
we pay for a childcare area that's in that business park or something, and we all paid it
Yeah.
together. I
Yeah,
see.
you can pool it together.
Oh, that's-
so.
All right,
That's cool.
interesting.
Yeah. Yeah, so it's an incentive,
I like it. Yeah.
which I don't
Doesn't hurt.
yeah. Yeah.
So, all right, moving on. And this is a personal. This next one, it feels like a personal win to me due to the time I spent in accounting services in the earlier part of my career. And it is the 1099 NEC and 1099 miscellaneous reporting rules. So, and it doesn't go in effect until next year, 2026. But payments made after December 31st, 2025, the reporting threshold is increased to $2,000, up from $600, and that amount is also going to be adjusted for inflation. So, in practice, in theory, that will reduce the amount of compliance responsibility that these businesses will have on issuing 1099s. $600 now doesn't go nearly as far as it once used to. But generally, 1099 reporting, it could be a huge burden. And the general rule for reporting a 1099 is, so anybody that you paid, so now $2,000 to as a business, anybody you pay $2,000 to, you need to send them a 1099 for services rendered, right, to your business.
Yeah, it's a business paying.
Yes.
So
as if a business pays an individual or another business for doing some service,
Contractor type services or
yeah,
anything.
then you're required to issue a 1099 to that person or business that did the service for you, but you also have to report it to the IRS, right? So it's a way for the IRS to track who's getting paid.
Right. They're making sure income doesn't go unreported.
That being said, and just a note, like, just because you don't get a 1099 from somebody doesn't mean you don't have to report.
This audio was created with podcastle.ai.
Because you don't get a 1099 from somebody doesn't mean you don't have to report income. Right? Like, if you earn the income, you have to report it whether or not it was. If you made $1,000, just because you don't get a 1099 doesn't mean you don't have to report it.
Yeah.
So,
Yeah. So that kind of goes along with the 1099K rules. So a 1099K is similar to a 1099 NEC or a 1099 miscellaneous, but a 1099K is from a third-party network. So like Venmo, Cash App,
Square.
Square, Amazon. If you sell things on Amazon and they take payment for you, you'll get it from Amazon. So third-party network transactions starting in 2022 needed to be reported if the gross amounts are more than 20,000 and the total number of transactions more than 200. For a couple of years, for the past couple of years, there's been a lot of talk about, because they were changing the rule where there was like no threshold and the number of transactions, and the amounts were $5,000 and then $2,500 and then going all the way down to $600. I remember there was a lot of people that were like, the IRS wants to know if I made $600 on Venmo or something like that.
Right. That was the big issue. A lot of people were talking about Venmo. Like, oh man, like we're gonna have all this reporting if I'm sending lunches back and forth between my buddies.
Yeah.
I mean, Derek's Venmoed me for canes like 3 times in the past month.
Yeah.
I want to have to start reporting that.
Yeah. So they changed the rules now to where it's $20,000 and the total number of transactions is more than 200. So
That's nice.
it'll help with that. But again, if you're running a business through Venmo, Square, whatever, and you don't get a 1099K, that doesn't mean that you don't have any income to report. You still have to report your income. You just might not have received a 1099K.
Yeah.
So
Yep.
So those are just like information reporting things.
And that's nice. And again, that relieves some administrative burden, right?
Yeah, well, $600 is not much.
Yeah.
And there was a lot, filing a lot of 1099s can be cumbersome.
The amount of 1099Ks that like Venmo or a Cash App would have to start distributing every year if that was if 600 was the threshold.
Oh, yeah.
That's insane.
And that's a real burden. It's a crunch to get all that filing done because so the year ends and then you've got to have 1099s filed within a month.
Mm-hmm.
Yeah.
So, it can be an administrative burden, especially for your small businesses.
Yeah.
Right? Where you don't necessarily maybe have a full-time accounting team, handling all that stuff for you. So, that's some relief. Last thing that we're going to touch on in this bill, and keep in mind, this podcast is not exhaustive. There are lots of other random things like
This is a really long bill.
yeah, like nuclear expenses, credit, and
What was
like,
what was it called? It was called the Zero Emissions Nuclear Power Production Credit.
yeah, they made changes to that, and
Carbon oxide sequestration credit.
Yep.
Sequestration credit.
so there's lots of other things in there, and if you're in a niche industry like that, then they'll apply to you. But this one is Section 1202, qualified small business stock, and
Which we actually talked about that on
Yeah.
our C Corp podcast.
Yes.
So this is like an update
yeah,
to that.
and this is a good update. They're essentially expanding qualified small business stock incentives. So the first thing they're doing is they're providing for a tiered exclusion of qualified small business stock. So previously you had to have held the stock for 5 years, and then you could qualify for an exclusion on any gain. Now, so for any stock acquired after July 4th, 2025, you can exclude 50% for stock held for 3 years, 75% for stock held for 4 years, and then after 5 years, you're at 100% on potential gain exclusion. And then also, the per issuer limitation increases up to $15 million, up from $10 million. And then the total, so in order to qualify as a small business, to have qualified small business stock, there is an aggregate gross asset ceiling of $50 million. And now that's been increased to $75 million. And the 15 million and the 75 million once again are adjusted for inflation. So that will be a benefit to these small businesses.
Right.
And these are kind of companies they're right in our wheelhouse as a firm. We deal with a lot of small business, and so this is exciting kind of for us.
Yeah. So a lot of changes. Some we don't know why, and some are great. Research and experimentation, awesome.
Yeah.
I'm glad it's 100% again.
Then also, this is the evil yellow deal.
Yeah.
So,
Yellow old deal. So the Green New Deal.
yeah.
Awesome. Well, yeah. So if there's anything that we didn't cover, feel free to reach out to us again. We read our emails, and we're on YouTube, Spotify, Apple, whatever.
Yep.
So
Awesome.
thanks so much for listening.
Thank you all.
For more information about Larson & Company and other educational material, you can find us at our website, larsco.com, also linked in the show description. For questions or suggestions on future episodes, you can contact us at larsonpod@larsco.com. If you would like to learn more about today's episode topic, additional resources can be found in the episode description.
This audio was created with podcastle.ai.